Welcome to CFA Learning Study. Reading. Specific investment decisions. Lesser bears most of risk and rewards. Lesser responsible for servicing and maintenance. Period of lease short, less than useful economic life of asset. Asset not shown on lessee's statement of financial position. Lessee bears most of risks and rewards. Lessee responsible for servicing and maintenance. Supplier paid in full. Lease or buy asset capital replacement rationing. Sale and leaseback. Sale and leaseback is when a business agrees to sell one of its assets to a financial institution and leases it back. Primary period of lease for assets useful economic life, secondary, low rent, period afterwards. Asset shown on lessee's statement of financial position. Lessor receives, taxable, income and tax depreciation. Help lessee's cash flow, cheaper than bank loan? Steps in lease or buy decision for tax-paying organization. Calculate the costs of leasing, lease payments, lost capital allowances, lost scrap revenue. Calculate the benefits of leasing, saved outlay on purchase, tax on lease payments, discount at the post-tax cost of debt. Calculate the NPV, if positive, lease is cheaper than post-tax cost of loan. An alternative method is to evaluate the NPV of the cost of the loan and the NPV of the lease separately and choose the cheapest option. Page 5511. Specific investment decisions. Lease or buy asset capital replacement rationing. Equivalent annual cost method. When an asset is being replaced with an identical asset, the equivalent annual cost method can be used to calculate an optimum replacement cycle. Calculate present value of costs for each replacement cycle over one cycle only. Turn present value of costs for each replacement cycle into equivalent annual cost, PV, over one replacement cycle. Cumulative PV factor for number of years in one cycle. Capital is where a company has a limited amount of money to invest, and investments have to be compared in order to allocate monies most effectively. Soft capital rationing, internal factors, reluctance to surrender control, wish only to use retained earnings, reluctance to dilute EPS, reluctance to pay more interest. Capital expenditure budgets. Hard capital rationing, external factors, depressed stock market, restrictions on bank lending, conservative lending policies, issue cost, relaxation of capital constraints, joint ventures, licensing, franchising, contracting out, other sources of finance. Profitability index. PI equals PV future cash flows, excluding capital investment, PV capital investment. Example. Project A has investment of $10,000, present value cash inflows of $11,240. Opportunity to undertake project lost if not taken during capital rationing period. Compare uncertainty about project outcomes. Projects are divisible. Ignore strategic value. Ignore cash flow patterns. Ignore project sizes. Thanks so much. Watch the video. Comment, share, like, subscribe.